Welcome, everyone. My name is Shirley, and I will be your moderator for tonight's webinar, Unlock 2024 Year-End Tax Benefits, Expert Advice for Doctors. I am excited to welcome Bob Gray as our speaker this evening. Bob Gray, owner of and partner at Gray-Pilgrim and Associates, LLC, has over 30 years of experience assisting with managing practices, improving financial success, and future planning. Very eager to hear what you have to say tonight. Before we get started, I'd like to take a moment just to go over some quick housekeeping. If you have a question, please go ahead and type it into the Q&A box at the bottom of your screen. We're going to be answering them live at the end of the presentation, but go ahead and put your questions in as they arise for you, and just get them in there, but we will get to them at the end of the presentation. CE is not available for this webinar tonight. And we will also be sending you out sometime over the next week a link to the recording, to tonight's recording. As promised, we also do have an exclusive tax tip sheet just for everyone here, which we're going to put in the chat in just a few moments. Okay, with that said, without further ado, Bob, welcome, and thank you again for being with us tonight. I'm going to pass it over to you now.
Hey, thank you very much. Well, welcome aboard, everybody. Tonight we're going to be talking about tax planning. I am Bob Gray from Gray-Pilgrim and Associates. I do have my email address up here on this slide only because I am offering to answer a few questions for anybody. We're going to leave some time at the end, but jot that down if you're interested, because I may be able to help as a follow-up when we're done here tonight. Let me first start with, of course, what the attorneys always want you to do, and that is disclaim that we're actually giving any real tax advice tonight. All kidding aside, the whole point of these kinds of webinars is not to really solve your tax problems. The idea is really just to give you the kind of things you want to be talking to your tax advisor about. And so we really want to just light the fuse and hand it back to you and give you, some better skills at what to be talking about and, what might be important to you. So that's really the point of tonight. I am Bob Gray. I'm an instructor for this Henry Schein Virtual Academy. I've been doing this for many years for Henry Schein. I also lecture to medical and dental societies pretty much all over the U.S. I travel a lot. I have over 1 million miles on United, so I do a lot of traveling. I'm a founding member of the Academy of Dental CPAs, and I'll come back to that in a minute as to why I brought that up for our physicians here tonight. I really have spent my entire career working with healthcare professionals, though, and so I do feel, very well qualified to be talking to you here tonight, and happy to, help everyone with a little bit of tax planning as we go. As on a side note, though, I don't know if we have any winos that have signed up tonight like me. When I'm not doing taxes, my wife Susan and I love going out to Napa and chasing after these boutique little vineyards and finding those 100-point wines. The big wineries obviously are doing it for money. And, if you're doing it for money and you're not doing it for art, it's rare for them to get 100 points on some of these wines. It's these funny little vineyards off to the beaten path that seem to always be the ones that are the best to find. If you Google Trace Perlas, you'll find that if you're interested in that sort of thing, you might want to seek them out. But let's get back to taxes. I mentioned the ADCPA, and they thought, well, why did I do that? Well, the reason was we started this organization, but all of the members of the ADCPA work with both physicians and dentists. The organization was created to focus on dental issues specifically, but I would tell you that all of us do both, and we're all over the United States. If you go to adcpa.org and click on the state near you, you'll find a CPA who specializes in working with healthcare practitioners. Obviously, I'm very biased, and I think specialists are better than people who are not. And if you look on the map and you see a place where you're in a state with no red star, trust me, many of the members like myself travel all over the U.S., and, so all the states are covered by someone. If you click on the one nearest you, you're going to find an accountant, again, who specializes. People ask me all the time, well, Bob, aren't the tax rules all the same? What's the point of specializing? But I would tell you, if you don't really understand how a medical practice functions, and you don't know how they work, you don't know what the overhead should be, you don't know anything about the metrics of the practice, it's really impossible to help a doctor maximize net income. So again, I always just say if your accountant's not a specialist, consider switching to one who is. It's the only shameless plug for Gray-Pilgrim I'll throw out tonight, because this really is more about the tax and not about me. This is intended to be an educational seminar. Here's what we're going to talk about tonight. The first thing we're going to talk about is the legitimate ERC refunds and claims. There have been a lot of issues with these ERC claims, and we're going to talk a little bit about what they really should have been, what they are, and make sure you're not one of the people who's sort of in violation of making a false claim in that area. We're also going to talk about how to maximize your QBI deduction. That's the qualified business income deduction. That income deduction is 20% of your business income, not W-2. Got to be a K-1 or business income. And it's intended to be a huge tax savings for business owners. We're going to talk about how to maximize that for those of you who that's eligible for. And also for those of you that own your own, S corps and LLCs and partnerships, we want to talk about the pass-through entity tax. This has been around for several years now, but I'm surprised how many people, when I talk to them, unless they've brought it up to their accountant, many times they're not doing it. So I want to give you an example tonight of what that is and how it actually helps, and why it would be good for you if you live in a state with state income tax. We're also going to talk about the Section 179 bonus depreciation and accelerating them, and why that might be great or might not be for some of your purchases this year if you're talking about any new technology, new equipment. Also want to bring up, do I have the right retirement plan? This is one of the mistakes I see so often with planning when I'm talking to other clients. You'll get stuck in a rut and they'll pick the wrong plan. We're going to talk about all the different plans they have. We're going to touch on the limits, and so you can try to make sure you're in the one that fits you the best. We're also going to talk about several other little planning tips and some financial reporting, but I really want to leave time at the end for questions. You've got a free accountant here tonight. You can't beat the price. So I want you to, go ahead and type your questions into the Q&A when they pop up, and I promise we'll save time here at the end and address those as best we can tonight. If you ask too difficult of a question, I might have to ask you to take it offline. And as I said in the beginning, I did put my email address up there. It'll be back up again at the end. If you really do have a question you think I could help with, I'm not, if it's one of those things that requires 2 hours worth of my time to do the research, I'll cry foul. But if it's an easy question, don't hesitate, and I'm happy to reach out and answer. Let's dive in. So some of the easy thing, I wanted to take sort of the dessert off the top here, just some of the changes. For 2024, the standard mileage rate for business is 67 cents per mile, up from 65 cents, 65.5. And I bring that up because it's up to a point now where many times, depending on the value of the car you're driving and the cost of repairs and things like that, these standard mileage rates can actually beat the cost of driving a car, depending on how fuel efficient, all that sort of thing it is. So many times the benefit of just using this standard mileage rate is that you don't have to keep all the records. You don't have to keep all the repairs and gas and maintenance and everything associated with the vehicle. It's just easier to keep the mileage for business use, and then multiply it times 67 cents. That can be, again, just a time saver for you if it applies. The other thing I want to bring up is that the residential clean energy credit, it is 30%. 30% of the qualifying costs for things like solar, temperature control systems, geothermal, fuel cells, that sort of thing. The government's paying 30% of that. That's a pretty sweet deal, but it also now applies to battery storage technology, such as a Tesla wall or something like that. Even for if you have an electric car and you're installing a charger in your garage, that's another one of those costs that 30% of it can be refunded to you in the form of a federal credit. So I think that's a pretty big deal, especially as more and more electric cars are out there on the road. I want to switch topics and talk about how to maximize your itemized deductions. For those of you that want to know, the standard deduction for 2024 for married filing joint is $29,200. and it's 14,600 for you, those of you who are single. This is really important because you don't have to have any proof of any deductions whatsoever for charitable, mortgage interest, nothing, and you get 29,200. Again, a pretty good deal. What I run into with clients a lot, though, is they're hovering around that. Well, maybe I'm about 29,000. Look at the example I put here up on this slide. If you assume that somebody had, taxes of 10,000, and that's because they're currently limited, if you recall the SALT limitations, the total of deduction you're allowed to take for income tax purposes for itemizing is 10,000, regardless if your state income taxes and real estate taxes were much higher. And then I just threw in 15,000 for mortgage interest, pretty typical, and 4,000 for charitable contributions. The problem is you see that comes up to 29,000. But you get 29,200 for free. In other words, it didn't really make any difference. The entire $4,000 contributions that you made to your favorite charity did nothing to improve your income taxes. And the reason I bring this up is think about the possibility of, well, what if I went to my charity and said, listen, we're going to give you 4,000 this December, but I'm also going to give you 4,000 this December for next year. That's, my typical cash flow. It's going to fall in there. You can see what happens is now I've pushed myself over that standard deduction limit, and I would get a $1,520 tax savings, depending on whether your state and federal income tax level. It's a pretty approximate, but again, it's an opportunity to pick up and go beyond your standard deduction and actually get some benefit out of making a charitable contribution. I said we were going to talk about the ERC. This has really been, for those of you who know what the employer retention credit was, if you have employees and you were working back in the pandemic, you knew that in Q2 of 2020, the IRS came out with this employer retention credit. They were trying to have you continue to pay employees in the midst of the pandemic, even when you were shut down, if you could, to try to help, Americans' cash flow. Basically, what they said was, if you were shut down from a government mandate, or if you were just suffered a 50% drop in your revenue in Q2 of 2020 as compared to 2019, you were automatically eligible for up to $5,000 per employee. Pretty good deal. They changed it in 2021 and said, oh, you only had to have a 30% drop in income for those time periods. They even applied this to what they call a recovery startup business for the third and fourth quarter of 2021. If you look at a recovery startup business, it's basically somebody who was not in business in 2019. They started after February 15th of 2020, so they didn't have anything to compare it to. So if you started up and your gross receipts did not exceed $1 million, and as long as you had some employees, you could actually qualify for this as well, just because you started a business in the midst of that pandemic. Again, it was a pretty sweet deal. Here's the problem, that when you talk about a government mandate, we're not talking about, was it inconvenient? Did I have to stretch patients out farther? Did I have employees that didn't show up? Did I have, was I affected by the pandemic? Everybody was affected by the pandemic. What they're referring to, and I have an example in the lower left corner there, the state of Arizona issued a stay-at-home mandatory order on March 31st, and they didn't lift it till May 15th. So that really is the only period of time that is truly under what the IRS thinks is the government mandate. So there's a lot of confusion about whether or not, again, I would qualify if I was just affected by this, if I had, if it was annoying to my practice. Not true. And if you did pay, if you did qualify in 2020, it was $5,000 per employee, because it was 50% of wages up to $10,000. In 2021, it was up to $7,000 per employee per quarter, up to $21,000. So we're talking about, again, the ability for $26,000 per employee if both years you apply for. So that could turn into a lot of money, and it was all tax-free in terms of, it reduced your deduction for wages, but there was no immediate income tax on the dollars that came in from there. Here's the problem. So many of these specialty refund, houses popped up, these refund mills, the IRS called them, and they offered to, file your claim for you. And hey, we're only going to take 25 or 30 or 35% of the refund as our cut. Wow, let me tell you, beware of the consequences, because if you didn't really qualify, and they just said, hey, let's go get 26 or 21,000 per employee, and you signed up and you did that, there's going to be some potentially really big issues coming down the road. The IRS has said that, even this is right off the IRS website, the employers are warned of these third parties promoting improper employee retention credit claims. And so any improper claim is going to result in the repayment of the credit along with penalties and interest. Think about it now. Maybe I got $100,000 because of these refunds, and I paid $30,000 out to my refund mill, and now I have $70,000. But I get audited and I find out that, oh, I didn't really qualify. I didn't have the drop in income that was necessary to truly qualify for that. Now I only got 70,000 because I already paid out 30. I might have to pay back 150,000. And good luck trying to go back against that refund mill and try to get your $30,000 back if that's the case. Those places, because the ERC is done, many of those places have closed their doors, rolled up the carpeting, and they're gone. So you're not going to be able to find some of those places if that was an improper claim. The IRS has created, this is the second now, they created a voluntary disclosure program, which is basically an amnesty program, the first time for 2020, and that's already been gone now, but now they created number 2 for anybody that got an ERC claim for 2021. And again, those were the bigger claims than 2020. This voluntary disclosure program is only open until November 22nd of 24, though. The thing is that if you have a question and you think you might not really qualify, they're permitting you to apply and only pay back 85% of the money. You get to keep 15%. So no penalties, no interest, no other repercussions, and you keep 15% anyway. Again, I think it's a pretty decent deal for the IRS. I just wanted to bring this up because, again, there's so many clients that were lured into these ERC claims, and I'm just not sure that all of them would pass muster under an IRS audit. So don't be caught in one of those that, don't be one of those doctors who unfortunately gets caught in that cash flow crunch. Let's switch topics and talk about this qualified business income deduction, the QBI. So if you operate as a sole proprietor, a partnership, corporation, S corporation, anything non-W-2 income. So if you just work for a hospital and you get a W-2, this is not for you. This is not going to happen. However, if you own your own practice, you own your own business, you have the opportunity to potentially have 20% of your income ignored. S corporations do really need to plan very carefully, though, because as you know, in an S corporation, a doctor is required to take what's called a reasonable salary. Now, there's tons of court cases about what's reasonable, but remember the W-2 part of your income does not qualify. So doctors who are already S corps are probably thinking, well, gosh, how low can I go for salary? Because I want all my income to be dividend income in K1 and subject to this 20%. But you just have to be reasonable. And that, we can talk about that if you have any other questions at the end. But that's why I say be sure to balance your W-2 wages and your S corp income. You want to make sure that you keep that salary as low as possible to maximize that deduction. But your profits also have to be below the AGI limits. I have an example coming up where I'm going to show you exactly how we did the calculation. But physicians, dentists, accountants, attorneys are all of the special group who got, the shaft. And now we have income limits. If you're just a real estate investor or a manufacturing company like that, there are no income limits. I'll point those out when we come up to this calculation, but just realize that maximizing this QBI deduction can actually be a pretty big deal. I'm going to come back to that because I want to talk about purchasing equipment, and then I'll wind these two things back together to show you how it works. Section 179 is the part of the IRS code that says, hey, even though I bought something that I have to potentially depreciate because it has a useful life of more than 1 year, I'm allowed to elect 179 and just write it off immediately as if it was just supplies. Bonus depreciation is similar. It was 100%. It dropped to 80% in 23. It's going to be 60% now for 2024. Bonus depreciation is fading away. At a time when they were both similar at 100%, the only difference was, well, does my state tax, apply? Some state income tax, if you have state income tax, some states permit 179, but not bonus. Others permit bonus, but not 179. So it may be just a state tax deduction as to whether or not this is new or used. I also point out that in order to take these deductions, either one of these, this equipment actually has to be placed in service before the end of the tax year. I get questions every year where someone says, oh gosh, I'm going to go out and buy a new computer system, some new equipment, whatever the case may be. And I just called my sales rep. It's December 29th. They're going to go ahead and give me the invoice. I'm going to write them a check, and I'm sure it's going to be here real soon. Well, the IRS says it has to actually be available for use. That means plugged in, and it could have been used. Doesn't have to actually be used. It just has to be could have been used, available for use. So, you got to make sure that if you're going to make a decision to do some of these upgrades, do them now so you have all the equipment in place and truly qualified. Again, it's got to be placed, and this does work for new or used equipment. So either one. Let's just say here's one of just the tax effect on this equipment, though, what I think a lot of people don't realize. Let's say that you got $150,000 worth of new technology, whatever that may be, and you financed it with one of the deals that says that, 6 months, no interest, we just accrue, or 6 months, no payments, we accrue the interest, and then you start to pay. And that's a pretty popular, it's available widely, I believe, through Henry Schein as well for many of you. If you do that, you wind up with a about $45,000 tax deduction for 2024. What people don't also realize is that because you reduced your taxes in 2024, you now are allowed to pay less tax during the year of 2025 and pay the balance of it at the end because your requirements for estimated payments have been dropped. So it doesn't mean you save taxes in 25, it just means you save the cash flow of having to do it. But look at this, I bought $150,000 worth of equipment. I haven't made one payment on it yet. And I'm $55,000 better off by next April of 2025. I have $55,000 more cash in my hand because of the tax savings than if I didn't do it. So if you're concerned about, maybe the learning curve on some new technology, or if you're just on the fence about whether or not this would be right for you, realize there's a pretty significant benefit, to buying new equipment, especially before the end of the year here. Again, I mentioned that it affects the tax payments for 2025 because if your AGI is over 150,000, you have to pay either 90% of the current tax for that year, which would be 2025 now that we're talking about, or 110% of the tax for the prior year. So again, if you had a big equipment purchase in 2024, you probably would only want to pay 110% of 2024 tax, which could be significantly lower than 90% of 25's tax without this big $150,000 purchase. So that's why it's the cash flow item. But I would tell you that if you could lower your taxes and not have to pay even an extra $40,000 until April 15th of 26. If I said to you, Doctor, here, take $40,000 and don't pay me back for a whole year, that's a pretty good deal. And so again, just realize that equipment has a 2-year effect, not just one, when you make that purchase. And these benefits do apply to all entities. It's whether you're an LLC, sole proprietor, S corporation. If you're a C corp, and there probably aren't many of you out there, or shouldn't be many of you out there, I would say that remember, you can't be purchasing it at the last minute. And for C corps to do this, you have to actually plan by taking less salary through the year. That lowers your W-2 and keeps your taxes down. And then by having the deduction for this new equipment, you still zero out your corporate tax at the end of the year. So it just requires a little bit more planning. Let me show you an example. I told you I'd tie the QBI and this 179 back together here as an example and why they can be really important. Remember I said that for physicians, the QBI has an income phase out. If you have a joint tax return and your taxable income, not the gross, the taxable income is under 383,900, you absolutely qualify. If it's over 483,900, you do not qualify. And there's that phase out in between where you get a partial credit for that. Here's the problem. Let's just say that I had $490,000 of practice income and I didn't qualify for this QBI. What if, in this example, I bought that $150,000 worth of equipment and I dropped my practice net income to $340,000? Well, you can see now that because I didn't get a QBI deduction before, and I do get a QBI deduction now, look at the difference. I only bought $150,000 worth of equipment, but I get a $218,000 tax deduction because that helped, move me back into that area where I'm actually, eligible for the QBI deduction, that extra 20%. What a huge difference that makes. I bought, $150,000 worth of equipment, and in this case, I would save $64,000 if I was able to pull that back into that QBI and the tax savings for the equipment itself. Before we were talking about just the tax savings on the equipment with the 179. But again, if this is the perfect time for you to go, oh, well, maybe this would pull me right back into that window, I'd be a lot better off. So just realize that those two things together can make a big difference. I want to switch and talk about this pass-through entity tax. Back in 2018, starting in 2018, the SALT limitation, which is the state and local income tax, dropped to 10,000. So it doesn't make any difference whether you've got, 15,000 in real estate taxes and 20,000 worth of state income tax, you get a $10,000 reduction. That's it. Bad deal. What some states have done is do a workaround through that. What they basically did is offer to change the state tax rules to say that, in fact, you, the entity, the S corporation, the LLC, the partnership, could actually elect to pay the state tax for the owners, so that now your K1 has a tax credit showing on there. And because the entity paid it, you can take a federal income tax deduction for the state taxes that are paid. So what a great workaround, because you still get 10,000 on your personal tax return. But if your S corporation could pay another 15 or 20,000 in state taxes for you on your behalf, all that becomes deductible from a federal standpoint. And there are 34 states that have enacted some PTE. So if you're one of those 34, you can see them listed down below. Make certain, if your accountant has not brought that up, that you are in fact taking advantage, because this is just a no-brainer. You definitely want to do pass-through entity tax. Here's just a really quick example just to show you the benefit. Here's a doctor, who has an S corporation, has 266,000 of wages that they have taken. Without the pass-through entity tax, they got a K1 of $350,000 for a total of 616. However, if you looked at the income tax, I picked a state that had a $17,500 state income tax on $350,000. Now, if the practice paid it, the K1 would drop down to $332,500. So again, that flows through to your federal return. You'd wind up saving $6,100 in federal tax by just electing to be taking advantage of this pass-through entity tax. One of the things I want to talk about too is talking about practice expansion. A lot of people have never heard about cost segregation studies. I'm going to go into that in a lot more detail, but one of the other things is that just relocating. If you happen to be one of those physicians who did a big build out, maybe you put several $100,000 of your own money into a leased space, and then you outgrew it. And a number of years have gone by, and you're like, well, I just need more space. What happens though when you abandon those leasehold improvements, and a lot of doctors forget, is you wind up with getting a very big tax deduction, and that can really help in terms of the tax advantages associated with making that decision to move into a bigger space. I'll give you an example here. Let's just say that you did 300,000 of leasehold improvements back in 2014, And you've been amortizing that cost over 39 years because you didn't do a cost segregation study. Again, we'll talk about that in just a minute. Now you decide to relocate the office, but when you leave this old office, you get an immediate tax deduction of $215,000. Well, that can make a huge difference in how affordable it is to make this relocation attempt and to, have the cost of the new building. Because when do you need the tax deductions the most? Is when you've just signed on for a new big mortgage and have a lump in your throat, right? That's when you want those big tax deductions. So realize that walking away can have a big effect on the affordability of that new space. So for cost segregation, I told you we would talk about this. I call this how to turn studs and drywall into a Section 179, medical equipment expense. Cost segregation has been around for a long time. This really started when the Hospital Corporation of America was audited. They said, listen, let me back up. If you are a piece of commercial real estate, your IRS says you have to depreciate that over 39 years. But we all know that the carpeting, the ceiling tile, a lot of the things are never going to be there 39 years from now. So the Hospital Corporation of America just said, hey, we're just going to do it what we think is a reasonable way. And of course, the IRS fought them, but they lost. And so now there's a whole series of specific things you have to walk through in order to break a building down, but you can break it down into its pieces and depreciate it. Here's a quick example. This is $1 million building. And yes, it's going to have $400,000 and a 40% bracket in tax savings over the life of the building. But without a cost segregation study, the straight line depreciation is $25,000 for 40 years. They say it's 39 years to the IRS, but you have to take a half a year the first year and a half a year the last. So it comes out to 40 years. With a cost segregation study, many times at least 20% of that building is going to wind up in the 5-year category and a small part in 7 and 15. That would be an $80,000 tax savings in the first 5 years. And again, when did you need it the most? It's when you just, signed on with this big debt, bought new equipment, built a new building, and did whatever you're going to do. So keep this in mind. It's easy to get a free analysis. This is just a sample of what one looks like. I know there's a lot of numbers on this page, but just trust me, this is one of these things that just says, well, hey, based on my building and my configuration, what would I be likely to save in income taxes? And you can see over in the green here, there's some projections. This is a $1 million building that you built. The next slide is a $500,000 in just tenant improvements. If you see there, this is 45%. 45% that went into the 5-year category. And that's because in tenant improvements, you already have the structure. You've got the exterior walls, the roof, and the windows and the doors and things. You're just doing the interior improvements. And the interior improvements are the ones that are most likely to wind up in that 5-year category, not 39-year. If you remember nothing else about this topic tonight, just remember these 2 boxes, right? One is the yellow box. I don't want that. I don't want a building that I'm stuck with 39 years. I do want one where it's broken down to pieces. But let me just give you a really quick example here. Everyone knows what that is, right? Outlet. But no, it depends what's plugged into it. If that outlet is, if a computer is plugged into that outlet, now that outlet, all the wiring that goes back to the breaker, part of the box, part of the building permit, becomes part of that computer and immediately tax deductible in the year that you built the new building. And it can turn into like a $350 outlet because of all the costs that are allocated to go with that. Another quick example is just, what if this is a lights, just a wall sconce for, extra lighting. Is this something that has to be 39 years or equipment? And again, the answer is it could be equipment because it was not necessary. It was not an integral part of the building. It was there for decoration. So that's another example of the kind of thing they do. But all the infrastructure, all the wiring, and all the plumbing that goes into exam rooms and things like that, all of that winds up in that 5-year category. The thing that doesn't qualify is the actual load-bearing walls, the roof, the windows, the doors, that sort of thing. But again, that's why I mentioned in a leasehold improvement, it might be, a lot higher cost segregation benefit than if you're building your own building. And the other thing that never qualifies is land. So the actual purchase of the land itself is not going to be anything that you're going to be able to accelerate for depreciation. But as I mentioned, just if you've done a building project, keep cost segregation in mind. As the final follow-up, I have to tell you, though, that one of the best things about this is you can actually time your cost segregation study. Look at the chart that's on the left here. This is the 2024 federal tax brackets. You can see over here that the taxes start out at 10%. For a married, filing joint, it's up to $23,200. It's only 12% till you get up to $94,300. I think taxes are on sale when they're only 12%, right? I mean, I've had some doctors come up to me and say, "Hey, Bob, I didn't pay any taxes at all last year. I built a new building and I wrote off all my income." Well, I think you wasted some tax deductions, because remember, to do that, you had to waste some of these tax deductions only getting a 10 or 12% benefit. I think I'd rather wait till I'm in the 32 or 35% bracket and then takes those tax deductions, right? I'm happy to pay income tax on $50,000 to $100,000. I just want to make sure I've saved those deductions for down the road. So maybe you bought enough equipment, enough new chairs, tables, lamps, computers, whatever other things when you built that new building to qualify and keep your income down where you wanted it to be in that new building year. Well, then just wait another year, wait 2 years, and do the cost segregation study, because the rules on cost segregation say that I'm allowed to wait until I can actually bring all the depreciation that I should have taken for the last 2 or 3 years and now bring it into the year 3 and take a tax deduction for it now. And so, again, a very sweet way to keep your income down. And again, when you built this new building and have kind of a lump in your throat. So just keep that cost segregation in mind. I want to switch and just talk about HSAs, Roths, and some 529 plans and some of those limits, kind of veer away here. The contribution limits for HSAs have gone up significantly over the years. It's now $8,300 for families. And that's, for high deductible health insurance, this is a pretty sweet deal because there's no income limits on this. If you have high deductible health insurance, you can qualify for this deduction. The IRA limits have gone up again as well. $7,000 per person, or $8,000 if you're 50 or older, up to the maximum of your compensation. So if you have a child that worked, for instance, and they only made $6,000, then they could only put away $6,000, not $7,000. But just keep that in mind, that that's a nice opportunity to add some money if you can. Contributions to 529 college savings plans I want to point out, are considered completed gifts for federal tax purposes. So for 2024, the most you can put in is $18,000 per donor per donee. So a husband and wife could give $36,000 to a child in 1 year for a 529 plan without having to file a gift tax return. You can elect to bunch some gifts and get over $50,000 a year, but again, you want to try to avoid the opportunity to file a gift tax return and go through that hassle. If you can, keep those deductions limited to $36,000, and you'll be fine. The contribution limits for the IRA, though, for the Roth IRA, are a problem for a lot of clients. If you're married and you only make, I say, $240,000, you are completely ineligible to make a direct Roth IRA contribution. But there's this thing called the backdoor Roth. And I wish the IRS made it easier, but of course they don't. In order to qualify for this backdoor Roth, what you have to do is make a non-deductible traditional IRA. And your income could be $1 million, and you're still eligible for a non-deductible $7,000 or $8,000 IRA contribution. What you do then is tell the broker, I'm going to put the money in, and I immediately want to convert that to a Roth. Roth conversions are permitted for high earners. Direct Roth contributions are not. So you just have to go through the gymnastics of making a traditional contribution and then converting it. But again, now you have 2 different buckets. If you build up some money in a Roth IRA, as you know, the Roth IRA is not deducted when it goes in, but all of the money grows tax-free. And when you draw the money out at retirement, it's not taxable. The benefit of having some money in a Roth IRA like that is maybe you're retired and then I go to buy a car or something like that. Well, I didn't really want to go pull an extra 50,000 or whatever out of my retirement account and pay tax on it that year. Let me go dip in my Roth IRA account this year to buy that car or something like that. It just gives you a lot more complexity and flexibility in planning in retirement. Speaking of retirement, I want to talk about selecting the right pension plan. We talked about the IRAs. Those are sort of the base level, opportunities. The next plan up is called the Simple IRA plan. That is a maximum voluntary contribution of $16,000, 19,500 if you're 50 or older, plus a 3% match of whatever your income is. So if you were a doctor who had a $300,000 W-2 from your S corporation, let's say, and that would entitle you to $9,000 plus the $16,000, that would be a $25,000 pension contribution that's tax deductible. You do have to carry your employees along with also a 3% match for them as well. But if that size shoe fits, the nice thing about the Simple IRA plan is it's completely free. There's no requirement to file any income tax returns with the Department of Labor. There's no other special reporting requirements. It's just an easy way to have a pension plan. The next step up is the 401k plan. For this year, that has a maximum voluntary contribution of $23,000, again, $30,500 if you're 50 or older. But when the practice matches and makes voluntary additions to that, that can go up to $69,000. Again, staff has to be included in some of that, so you have to look at your staff census to see if it makes sense to you. And again, for the right doctor, the defined benefit plan, which is a totally different type of plan that talks about the benefit and not the amount you can contribute this year, those are up to $376,000. Especially if you're an older doctor with a younger staff, this can be an amazing tax deduction. Because I have a couple doctors that are putting away $300,000 and the staff cost is about $15,000. So they're writing a check for $315,000 and they get $300,000. Now, again, it takes a significantly younger staff to make that kind of a spread. But again, the point of tonight is to let you know that all of these things are out there and available. And if you really are, have some extra cash to burn, doing the combo plan of having the cash balance and a 401k jacks the contribution limit up to $452,500, and this is per person. So realize there are options out there. If the size of the pension contribution you're making right now is not the right size shoe, as I say, just realize that you have other options. And if you do elect one of these defined benefit plans, you don't have to do the maximum. You don't have to do $300,000. You could just do more than your 401k contribution and enjoy the benefit of a higher amount. One of the things, this is not apply to a lot of you, but I wanted to point out that there are a few doctors that have graduated and then started their own LLC and worked with another doctor as an associate, but they have their own LLC as a separate, thing. The thing is that, when you were in medical school, you're required to purchase textbooks, maybe loupes, some other, a stethoscope, medical equipment, depending on what your specialty was, maybe some other things you purchased. And again, in med school, you probably purchased a laptop, you had a printer, some other things like that. All of those things, when you come out and actually now start your own business and you convert those things from medical or from educational use to actual business use, those become immediately tax deductible. And again, they don't have to be used, they have to be available for use. So that's what makes them tax deductible. And again, starting out your new LLC, you can pick up several $1,000s in tax deductions by bringing back some of this equipment and making it tax deductible. The other thing I see overlooked quite often is the opportunity for doctors who want to start what's called a family limited partnership. The FLP is an interesting type of partnership because they have to all be family members to be partners in this. By the rules of attribution, they're all treated as one taxpayer. So what happens is if you have, let's say the doctor owns 99% of the building and you have one child who only owns 1%. Maybe that LLC has a profit because the rent is, covering more than the mortgage. Well, now that doctor could actually what's called anoint their child with that income. And even though that child only has a 1%, ownership interest, they might get a 30% distribution of the income that year. And depending on their age, whatever, that might be an opportunity to really push some money down into a lower tax bracket. I have a client, for instance, who have a special needs sister, and had her as part of this family limited partnership, and was able to spin some money off from his building to her in order to help her in a much lower tax bracket. And again, a way to sort of tax deduct it rather than just reaching into his pocket to help a sister out. Realize if you own your own building, and especially these, or if you have some very large investment accounts, these FLPs can be very interesting things for you to consider. I want to spin off and do one other thing that's tax related tonight, but it's not specific to your actual income tax. I bring this up because in 2021, the Corporate Transparency Act was passed. And in that act, it said that starting on January 24, anyone who started a business or owned a business was required to come to this financial crimes network in the U.S. Treasury and register your company so that they knew who the owners were. What they're obviously trying to find who are all the bad actors who have shell corporations and move money around that the IRS can't find. They don't want that. So they're going to make all these shell corporations register and say, well, who are the owners? Who are the individuals that are really behind all of this? So if you own a business or if you control a business, you're required to actually do this. I bring this up tonight because I have never seen one advertisement about this. I've never seen one thing. You don't see this on the television. No one got letters, from the U.S. Treasury saying, by the way, you own a business, you're required to do all this. And yet it's part of the law, and this, time's marching on here for all of you who already owned a business. You only have until December 31st to register. I have the website down there at the bottom, but if you just go and Google either BOI, which is beneficial ownership, or FinCEN, Financial Crimes Enforcement Network, either one of those, you'll get this link where you can go back and file. Again, I really bring this up tonight because if you had started a new company this year, you only had 90 days to file. So if you started a new practice in March or whatever, you had to be doing this by June. Everybody else who had already owned a business, whether it's your LLC for your building or your medical practice itself, you have until the end of 2024 to get it done. And any other business that you own at least 24% ownership or more than 24, it's a 25% limit. So if you're a partner with someone else in some other real estate investments and things like that, and you own 25%, you've got to go in and file and put that federal ID number in and say, yes, I'm associated with that company. Again, the reason I bring this up is the penalties are huge. It's $500 a day, up to 10 grand. And do the math, that's only 20 days. I'm 20 days late and I have to pay $10,000 for failure to do this. And if they show that it's willful, you didn't just not know it, they can put you in jail for 2 years. So, wow, not an outcome that I want for anybody who's listening to the webinar today. So I bring that up again. Go Google BOI or FinCEN and you will get to that website. I did it and it took me 10 minutes to do it. It was really pretty straightforward. I just had to put my a copy of my driver's license in. I had to scan it with my phone and upload it. It was just name, address, some basic sort of things. But again, avoid that $10,000 penalty. That's something I wanted to bring up tonight. Such a quick review because I want to save some time here at the end for questions. I mean, planning is really complicated. If you treat your accountant like an archaeologist and you wait till April and they're trying to help you, but now we're just blowing the dust off what already happened. You really can't do much to be proactive and help plan. I wanted to point out how big of an impact equipment can really have on your practice income when it comes to preparing your 24 taxes. Make sure you're taking care of that pass-through entity tax if you're in a state with state income tax and one of those 34. And again, we talked about cost segregation. Do not forget that if you did a project, and even if again you did something maybe in the last 3 or 4 years, consider going back and looking for that cost segregation study and picking up that extra depreciation. And again, don't forget to file with FinCEN. I promised I would leave some time here at the end tonight. My email address is up there. The phone and contact information is below. Again, don't hesitate to reach out if you think I can really be helpful, but I wanted to save some time here at the end. Let's go to the questions if we have any.
That's wonderful. Thank you so much, Bob. That was just such wonderful information, especially those reminders to make sure that that everyone's doing everything correctly. So thank you for that.
Sure.
And I did add, just for all our listeners, you will find Bob Gray's information in our Q&A chat along with a tip sheet. And okay, let me just read that first question from Jeffrey Petty. If you pay for the equipment in 2024, but start using it in 2025, do you deduct it in 2025?
So when you said use, that's not really the correct. Let me change your question. Okay. What was it available for use? Did I have it plugged in? Because as long as it was unboxed and sitting on the floor or the desk or wherever the case would be in 2024 and paid for in 2024, it is deductible in 2024. You didn't have to actually have a patient come in and use that equipment or whatever that would have been. It just had to be available for use. So by the opposite of that is if on purpose you purchased it, but now you find that there were some other big deductions that popped up towards the end of the year, and you don't want to deduct it until 2025. Even though you paid for it in 2024, what you can do is keep the box closed, push it off in the corner, not plugged in. And now when you do plug it in 2025, that's when it becomes deductible because now it's available for use. So depending on, whether this equipment needed installation or any technical other issues, that can really push one year to the other, but it just had to be available and could have been turned on. It didn't have to be turned on. Hopefully that answered the question.
Sorry, I was muted. Wonderful. Thank you, Bob.
Yeah.
This one from Shashi Sangi. Should we file every year details with FinCEN? Good question.
No, FinCEN, luckily, it's one of those things where unless things change, let's say you are the 100% owner of your S corporation and you filed this year, and now you brought in an associate and someone bought half the stock. Now they have a requirement to come in and amend that filing. But unless there's any change, you don't have to go back and do every year. It's a one-time shot.
Great, thank you. This one from Garrett Kalmar. Pro and con of Section 179 and depreciation regarding auto lease versus purchase. I'm in New York.
Okay. Well, so there's two questions there. Let me start with the first one, the 179. I mean, clearly 179 can be a huge, tax write-off if you purchase new equipment or, a building that could be run into cost segregation. As I mentioned, I would never say no to 179 if your income is high. The only time 179 or bonus depreciation becomes an issue is if, let's say, I just started my practice. I've only got 100,000 of taxable income for this year. Well, if I bought $100,000 worth of equipment, I don't really want to take a $100,000 deduction because, again, yes, I wipe out my income, but I'm wasting those deductions on those lower tax brackets. If you're a high earner and you bought equipment, though, take 179. That part's a layup. When it comes to the issue of leasing versus buying cars, I would tell you that for many practices, it's not really practical or it's not as advisable for the practice to purchase the vehicle. There's a lot of legal issues about that. If you were out in a practice vehicle and happen to run over somebody, whether or not the practice is also at fault, and if you get sued, as well as you individually. But it also means that you can't bundle your home and car insurance because you're obviously the practice owns the car and you don't. So many times what you do is wind up paying commercial sort of auto rates that are much higher than if they had bundled them as a residential. So the trick is to try to lease a vehicle personally, but then assign the responsibility to the practice to make the payments, because you as the president or as an officer of the company have elected to say that I want this as a benefit for myself in order for me to travel. And then make sure that you have your practice reimburse you for the use of your home office. The home office rules have opened up significantly over the last few years. And if you're now, instead of driving to your office, and that would be non-deductible commuting, you want to make sure that by having the practice reimburse you for the use of your home office, you're now driving from your business office to your clinical office. And that inter-office travel is business tax deductible, which can make a big difference, especially depending on how far away you live from home.
That's such a fascinating area. Thank you, Bob, and I'm sure there's more there to be explored. This question from Timothy Egan, can you only take the deductions from medical school expenses, such as the laptop, loops, etc., in the first year you set up your license?
No, it's actually any year that you converted them from educational use to business use. So let's say that you got out of medical school, took a W-2 job working for a hospital, and now an opportunity comes up to be an associate with a doctor, and you're going to be an independent contractor. You're 5 years out, whatever the case would be. Even though that stuff's 5 years old, now when you bring it into this new LLC and convert it to business use at its current used value, all those things were immediately tax deductible. But again, I think, typically when I look at these things for a lot of physicians, we could be talking about, $7,000 to $10,000 worth of stuff that you already owned that you converted to business use, because it could have been a computer, it could have been a desk, a bookcase. It could be anything that was related to that office. And again, you already paid the money. This is now taking pennies from heaven. You get a $10,000 tax deduction if you can line up all these medical textbooks and expensive things that you purchased while you were a student.
Thank you. And this question too is one that's pretty interesting. In one of the slides, it was mentioned that a child can be paid without working. Any limitations if they are in college and already working part-time?
So let me specify, I didn't mean to say that a child could be paid without working. They can actually not have to work. If you use their image, for instance, in your practice brochure, you can go by the Screen Actors Guild union minimums and pay your child for the use of their image on a website, their image in a practice brochure, that sort of thing, if you use it for marketing purposes. So that can be an easy way to justify paying someone up to $7,000 so that they're eligible for that Roth and make their own Roth IRA contribution. If you have a child in college, again, if that's still the case, paying them to either provide services or for the use of their image up to $7,000 is still great, because you get to tax deduct it as a practice owner, and the federal income tax on $7,000 is zero. So your child's not going to pay any income tax on the money, you get to tax deduct it. And again, I think, for most teenagers and college kids, unfortunately, you're probably reaching into Hip National Bank to give them money anyway, as I call it. And so, if there's a way you can make the practice, put it on payroll and tax deduct it, all the better. So even if they don't use it to start a Roth IRA, but those can be really effective for people with younger children. If you have younger children and you're paying them for the use of their image, throughout 20 years, and they had, 20 years of contributions to a Roth IRA, they're allowed to draw all of that principal that they put into that Roth IRA out and use it for college tax-free. So again, the practice paid these wages, tax deducted it, but now it's college money tax-free. So again, for those of you who have younger families, consider that as a possibility.
And this last question from Garrett Kalmar. I am a 50-50 owner of my podiatry practice. We have one office, about to buy another office, and do a ton of SNF acute rehab. Is there any benefit to split these entities up and have a primary holding company, tax-wise and legal protection?
Yes, the short answer is yes, because it gives you a lot of different flexibility. You want those two entities to be in separate LLCs, separate business entities. And what I would highly recommend is that if you think about having one sort of umbrella company, the umbrella company can do the billing for both. The umbrella company can employ all the people for both. But if the entities are owned by two separate LLCs, you have a legal firewall. Again, they do shoot accountants for practicing law without a license in most states. So I'll let you go back to your attorney and talk about the legal ramifications, but I would tell you for sure there are definite benefits to keeping those as separate entities.
Well, thank you so much, Bob, for tonight's presentation. That's all the time we have tonight. It went by very quickly, and just great information. So
Okay.
thank you.
Yeah, I hope everybody found the time well spent.
Yes, I know I certainly did. And by those, just by looking at those questions, I think the audience did as well.
Yeah.
And if you have any more questions that you'd like to ask Bob, if you'd like a consultation, please make sure to email him. You have his email along with the tip sheet uploaded into the chat. Go ahead and save that chat or download it onto your laptops, onto your desktops. And we want to thank you for joining us tonight. And thank Bob again for his insights. We recorded tonight's webinar and we will email that recording out sometime in the next week. We'd also love to get your feedback via our survey that's going to pop up on your screens shortly. And I want to thank you all again for joining us, and we look forward to seeing you on future webinars.
All right. Thanks, really. Appreciate it.
Thank you. Thanks, Bob. See you very soon.